A Few Lessons for Investors and Managers by Warren Buffett, or from Warren Buffett, should I say. The book's by Peter Bevelin. This book, my book of the week, fantastic. Absolute gold. Like, for everybody who wants to learn about money, business, investing, pick up this book. Pick up this book. I think it's essential reading. For a start, we all use money, you know? Our economy doesn't operate without money. You know, you don't go to work for free. You don't get haircuts for free. You don't live in a house for free. You don't pay. Your landlord doesn't, or the council, whoever owns your properties, don't give you homes for free. You don't get food for free. It's reciprocal. Everybody needs money to trade. So it's important to learn about it. And if you're going to learn from the best. Warren Buffett. He is the third richest man in the world. Third richest man. He's been the most successful investor, they say, of the 20th century. And he's fascinating guy. If you want to see right now, today in real time, there it is. Ooh, it's a bit bright, but you probably can't see it on here because of the brightness of the screen. But on the Forbes list, you've got Bill Gates at 75 billion for Microsoft. You've got Amancio Ortega at Zara for 67 billion. And then number 3 is Warren Buffett, 60.8 billion for Berkshire Hathaway. So again, he knows what this man knows what he's talking about. My thing is, if I'm going to learn something, I'm going to learn from the very best, and if you look at that list, the Forbes rich list, the 500 wealthiest people in the world, the majority of the billionaires are investors. So we're going to go over what an investor is and how they use their money, how they evaluate businesses, and what Warren Buffett does, really. And one thing I noticed about Warren Buffett, a lot of people, a lot of even successful people who are multi-millionaires and whatever, who are investors, they do a lot of complex stuff. And don't get me wrong, obviously Warren Buffett he understands all that stuff. But his stuff is when he talks, if you listen to any of his YouTube videos, which I highly recommend, watch all of them. Just sit down and watch all of them. You will learn a lot. It's very simple. It's not complex. It's not complicated. It's just common sense. But as we all know, common sense is not common, especially in action. Like this guy, what he does is he evaluates businesses based on results, based on the numbers. He reads annual reports. There's a really good video, actually. There's many, but I'll put a link in the description to a couple. There's a guy who's got a really good YouTube channel called Evan Carmichael. Love his channel. He does the top 10 tips for success for all these really successful people, like the world's successful people in all fields. And he's got a few for Warren Buffett. He's got like Warren Buffett's top 10 success tips. He's got his top 10 investment tips, and then he's got another thing for Warren Buffett. Like I can't remember what the other video was. It was titled, but I've watched them to death. So I'll put the link to Warren Buffett's investment tips in the description. Go check that out. And also, there's another video I saw where he was actually it's talking about Warren Buffett's. I think it's titled Warren Buffett's Investing in Real Estate Guide, but it's not really talking about that. It's really talking about his philosophy on investing. So he's being interviewed by these reporters on, in the financial newsroom. They're talking about stocks and all this. And there's a particular part where he's talking to this woman, and she's asking about how he knew to invest in this Chinese company and how, because it was a really good investment. And he says, well, I looked at the company, I read annual reports, I sit in my office and I read 6 hours a day, and I read various magazines, newspapers, books, articles, and annual reports. And I looked at the company, and it described a company that was profitable, because she was asking, how would you know to purchase this company? Because the average person, what advice are you going to give to the average person? Because the average person can't just sit there and see, oh, is it going to go up or down? Which is what a lot of people think investing is. They think it's trading. They think it's, oh, I buy low, sell high, and then I buy, and that's cool. You can make money doing that, but there's no control in that. It's gambling in a way. It's not really investing. Warren Buffett, he buys companies and he holds them because they produce, and then they give him a return on his investment, cash flow. So he looks at it in the standpoint of being an owner. He's buying a share in a company. So in other words, it's just the same as owning the entire company. So he said, well, I just, I read the annual report, and I could see that the price was a lot lower than the value. So the value's here and the price is here, then I'm going to buy it. It's a bargain. It's just the same as if, for example, you and I, we as a consumer, for example, say if we see an iPhone and it's the new iPhone 7. It's being sold at a shop for £100, and it's got no damage to it. It's in full functioning order. Maybe it's second hand, but it's in perfectly good order. That thing, it starts selling for like £700. Obviously, we're gonna buy it. Its value is a lot more than that £100, good for what it can produce. So, but that's a simple way of looking at it. But in terms of business, obviously, it's what income it's producing. What are the financials, the income statement, the balance sheet, and more importantly, the statement of cash flows. How much cash, how much liquidity, how much equity, how much cash is it bringing in? Is the business profitable? And he looks at the management as well. He doesn't just look at that. He looks at who are the people in the company, because a lot of times mergers and acquisitions happen of companies, and they change a lot of personnel, they make a lot of cuts, and I've never understood that either, because I'm telling you, all the things Warren Buffett's saying, I just get it. I really resonate with what he says and what he does. The more and more I learn about him, the more and more it just makes sense. I've obviously got a lot to learn. I'm not a billionaire, I'm not even a millionaire, not yet, but I've got a lot to learn. But it just, when you just listen to certain people and it just clicks, it just makes sense. I'm like, yeah, it's just common sense. It's not overcomplicating things. And in regards to this, it's just a lot of the things Warren Buffett says is common sense. It really is. And we're going to go through this book. This book is basically a collection. He didn't write it himself, but it's his words that are in here. So it's a collection of a lot of his quotes on various subjects. If you can see the table of contents here, we're going to go through all of this. So regarding these subjects here, Warren Buffett, Peter Bevelin, he's kind of structured the book into these sections in which Warren Buffett talks about these points on investing. So just in regards of acquiring a company, he doesn't provide the management, he doesn't provide the personnel. Him and his business partner, Charlie Munger, another very sharp, smart guy. I've got a book on him as well, Poor Charlie's Almanac, which I'll talk about another time. But when they evaluate businesses, they want to see the personnel, they want to see the management, they want to see the people involved. I always say, people first. Business is a people business. Businesses are about people. So he wants to see what the management team's like, how good they are, how efficient they are. He wants to see the talent in the business. He's not looking to replace them, especially if they've got the company to where they are now. Then why would he replace them? I've seen when the UFC was acquired by the new owners for $4 billion last year from the Fertitta brothers, and unfortunately they made a lot of cuts and they made a lot of changes now. UFC. I don't really know what's going on with the company in terms of the decisions that they're going to be making. I'm sure the owners are very smart people and they're going to make good decisions. But at the same time, there's a lot of changes in terms of what the UFC were doing before versus what they're doing now. That might be for the better or worse, but the company they evaluated at $4 billion for a reason, and the people involved in the company were the ones who brought it to that level. So I wouldn't understand why you would want to change it. Another thing he says is he only invests in businesses that he understands. He stays within his circle of competence. So he's not trying to just look at random businesses. Oh, Apple's a good stock, so Apple's a really cool company, so I'm going to buy stocks in that. Or chasing, shiny objects. He doesn't do that. Him and Charlie Munger, what they do is they look at businesses that they understand. So they can evaluate businesses. They understand its operational structure. They understand the market. They invest in things they understand. So for those of you who don't know Warren Buffett, he owns a company called Berkshire Hathaway. Like I said, he's worth like over $60 billion net worth. Now he also owns 10% of Coca-Cola, Geico, so I think that's a car insurance company in the United States. 15 minutes will save you 15% on your car insurance. I think that's their slogan. He owns Dairy Queen and a few other companies. Now, those are companies that he understands. He says he doesn't need to invest in Microsoft or anything like that. He goes, Bill Gates is great at what he does, but if I tried to do that, I couldn't do that, So he's not chasing, the gold. He's not chasing shiny objects. He goes for companies that he understands, and I really think that just makes common sense, and like I said, he reads annual reports. That's something I've started doing. So what I've done is I start printing out annual reports. I've got my little book folder here, and I've got a lot of them digitally, but I'm starting to print them out because I just don't like reading from screens all the time. It irritates the eyes. But anyway, so like one of the companies I've got an annual report for is Netflix. As you can see, there's a 10K report from Netflix. So this basically tells you the whole story of their business. So Netflix is a public traded company, and as a public traded company, they need to report all their financials, all their details to the public. And it's something you can get for free. Just Google Netflix annual report and you can download their annual report, or any company that's public, and you can read their annual report. Now, it might seem a bit dry to you, but it's actually very interesting because these annual reports don't lie. It's not a nice market. They do have nice presented annual reports. This one's it's a 10K. It's a bit just dry. There's no images and stuff. Some of them are very colourful. Like I was looking at 20th Century Fox's and Warner Brothers ones. Annual reports as well, and they're very colourful. They've got all the images. You see the Batman versus Superman, the Deadpool, and all this kind of stuff, with their television networks and the CEOs and the chairmans talking about the company and all of that. And they've still got that in here. But what this does is it shows you the numbers. It tells you the story of the company. Now, this doesn't lie. It shows you things like, it shows you the financials. It shows you what the company is earning, how they're earning it, what they're spending their monies on, accounts receivable, inventory. It shows you their net income. It shows you, amortization, depreciation, all these kind of things. These aren't terms you understand. I recommend doing an accounting course, learn these terms, because as Warren Buffett says, the language of accounting is the language of business. And unfortunately, a lot of people, when they're investing or trading, really, they don't understand what they're buying because they don't read financial reports. That's all he does. He reads the financial and he tells you the truth of the company. So if he sees that something's worth like 100 million and it's selling for 20 million, then he'll buy it. But actually, one of the things he says is he doesn't look at the price because he doesn't want to be influenced by the price. He evaluates the business and he sees what it's worth, or what he believes it's worth, based on the facts, and then he'll make a bid on that company. And then if the price is a lot lower than the value, he will purchase it because he obviously wants a margin of error as well. So, for example, with feature films, I mean, that's what I know. I know feature films, television. I've been in the television industry for over 10 years. So, and it's my passion. It's that's my career. So again, that's why I download Netflix's annual report as opposed to, say, Zara or Apple's annual report, because I don't understand those businesses, but I understand, I have an understanding of the television and film industry. And obviously that's where I'm going. I want to have my own company. So I need to understand how these most successful companies run. So the most important thing really is to analyze these things, because if you don't, you're going into that's why most businesses fail, because they don't understand this stuff. They're looking at, a lot of people are looking at revenue, or they're looking at even net income. But net income on a financial statement doesn't tell you the full story. You have to look at the entire story. You have to see the income statement, the balance sheet, and you need to see, the statement of cash flow. How much liquidity is the company producing? So one thing Warren Buffett and Charlie Munger say is they can't go to bed unless they've got the $20 billion saved away. Because they don't want to depend on the kindness of strangers. So their companies produce. That's what he is. Warren Buffett is what they call a value investor. So he's looking at the value of companies, not just looking at the price. Do I buy it low and sell it high? He doesn't care about that. He buys and he wants to hold it forever, and he wants it to produce. And there's in that video, in the link description that I've got below, the one where it was titled Warren Buffett Real Estate, I think it's titled. There's another part of the interview at the beginning where he's talking to a few reporters, and because they're talking about gold and the price of gold, and he says he doesn't know anything about that. What he knows is, he uses the farmland as an example, purchasing a piece of farmland. He says, well, if I purchase that farmland, I know I don't care about the price, what the price is going to be tomorrow and all this business, whereas if I buy gold, I'm buying it and then I'm hoping that in 10 years time, someone else will buy it for me for a higher price. But if the price changes, I don't care, because it's the price that I paid for it versus the value when I paid for it. Am I making money at that point? And also, once I've purchased it, is it producing for me? Which it will be, because it's got cattle, it's got sheeps and chickens producing eggs and milk and all this kind of stuff that's going to provide an income for him as an investor, because obviously you're going to sell those as food, so to the population. So I mean, it just makes common sense to me, a lot of the stuff that's in here. So I'm going to go over this book, I'm going to go over all these points, and let's see how Warren Buffett thinks. So a few lessons for investors and managers, should I say. Okay, so what Peter Bevelin says is, if you look at this book, like there's, I've highlighted all the key points, some of the key points I want to talk about, but he has his points in bold, sort of like to highlight what's being talked about, and Warren Buffett's is in normal print, so I'll just highlight when Peter Bevelin's talking and when it's actually Warren Buffett's quote, I'll say, and Buffett says, just so you know the exact words of the man, because that's really what we're looking at, what his words are, and my interpretation of it. Obviously, you can if you've got a lot more knowledge than myself, I leave some comments in the description below on some of the points that have been made and your understanding of that, because I'd love to learn as well, because I'm a student just like maybe a lot of you are, because unless you're Bill Gates or the owner of Zara, I mean, we're all students to Warren Buffett. He's the third richest man in the world. So when it comes to business, investing, finance, money, financial freedom, this guy, there's not many people better than him to learn from. So let's start. Okay, so just before chapter 1, there's a really good quote. It says, I'm a better investor because I'm a businessman, and I'm a better businessman because I am an investor. Warren Buffett, Warren E. Buffett. So that's the first quote that you see there. And one thing I want to say about that is Buffett. He started from when he was like 5 years old. He was selling newspapers, and he was also, while he was selling the newspapers, he was also doing financials. He was writing out financial reports for his newspaper business. So he was understanding accounting terms, from that young age. And then he acquired things like pinball machines. He'd put them in barber shops, and then he would partner with them, and he would make money from that. But he would also, again, he did the accounting, so he had the financial statements. So he had an income statement, balance sheet, a statement of cash flows to know how much money is going in and out, the expenses, the balance, what the company owes versus what it owns, in the balance sheet, and its statements of cash flow. So he knew he started from a young age, and it's not about how young you are. It's about the process of mastery. It's not something that happened overnight. It's not a luck thing. This person was diligently learning for many, many years. The guy is now in his 90s, I think, and he's been doing this for many years. Many decades. So if I liken it to like a martial arts analogy, for me, like, say I maybe I consider myself a white belt because I'm learning this stuff, but there's black belts. The black belts are the people who have mastered this stuff. In jiu-jitsu, though, there's something called a red belt. There's a belt called a red belt, and the red belt is someone who's been a black belt for at least maybe 50 years or a long period of time. So Warren Buffett, when it comes to investing and business and finance, he's a red belt. So he knows what he's talking about, like I said. So chapter 1, what investing in financial assets is all about. So Bevelin says, laying out cash today in order to get more cash back in the future. What return I will get on my cash depends on the price I pay, how much cash I get back, and when I will get it back. So Buffett says, long ago, Ben Graham taught me that price is what you pay, value is what you get. Okay, so for those of you who don't know, Benjamin Graham, he was Warren Buffett's mentor, and he wrote some great books on investing, and some really complex thing on security analysis of the stock market. And also, he wrote a book which Buffett thinks is the best book on investing ever written. And he's read a lot of books. Buffett, he reads 400 to 1,000 pages a day. So a day, and he's been doing that for like 50 years, over 50, 60 years. So he's read a lot of books. And he says that's the best book he's read on investing, by Benjamin Graham. So pick that one up. I'm definitely going to pick it up. I've had a little read of that. But that's one thing he learned from his mentor. Again, successful people have mentors. They have people who have done it before and then they model, which is what we're trying to do here. We're learning from someone who is very successful, and we're trying to at least get a little bit of knowledge that can help us in our life, So again, with the price versus the value thing, it's like this book, for example, I paid £15 for it. I think it was about £15, something like that. Hardback book. With all this knowledge from the third richest man in the world. Do you think this book is worth £15? It's worth a lot more. When I bought this book, in my mind, I was already thinking as Warren Buffett because I'd been watching a lot of his stuff on YouTube, and I'm a fan. And the way I look at it is it bringing me 10x? There's something called the 10x rule. Is it bringing me 10 times the value, the price, the value than what I paid for it? If I paid £15 for it, then I need it to be bringing me £150 worth of value. I think it's bringing me more than £150 worth of value, so it's a good investment. Say, for example, if you purchase a Louis Vuitton bag or something like that, and it costs like £1,000. Now, is the bag really worth £1,000? It might be a nice bag and everything. It's nice to have luxury items. I'm not saying don't do that, but is it really worth £1,000? Is it going to bring you £1,000 worth of value, over the lifetime of you owning that item? The answer is no. It's not. It's a bag. You can get a Sainsbury's bag and put your stuff in there. Technically, it just looks nice, and it's got that brand value that makes you feel good. Whereas this has got knowledge from one of the wealthiest men in the world, which you can apply to your business, that can bring you in an income, and help your business produce profits, help employ, hundreds, thousands, maybe millions of people, maybe even 10 people, but it's still bringing value to you and your family. So there's a difference between price and value, and I think a lot of us get confused with that. We look too much at the price. We've been trained to look at price, and there is a certain psychology to price, because price can change. You look at Starbucks coffee, for example. You go into Starbucks and you pay £3 for a latte or whatever, Americano or whatever you buy. I don't know how much coffee is in Starbucks. I don't go there that much, but on the occasional time I go in there and buy a green tea. I buy a green tea. It's like £2, 5p for a green tea. Now I could probably go into Sainsbury's and buy a whole box of maybe 20 or 30 tea bags of green tea for that same price. So why is the price changed? Because it's because of the brand. It's because it's Starbucks. It's because of the convenience of going in there, the experience that they're giving me in their cafes. It's for that social environment. People like to sit down and talk and go on the internet and chill. It's that's all what you're paying for. So the value of the coffee or the cup of tea is still the same, but the price has fluctuated based on the psychology, really. So one of the things I've learned a lot is price is based on psychology. And you see that with the fluctuations in the market, gold's at this price, silver's at this price, obviously a lot of that has to do with the fact that they print the currency, and it's worth less the more they print in proportion to the GDP of the, of the country or of the world or of the continent. So that has major effects on price, but then so does human psychology. When certain things happen, Brexit and all these other things happen, then you see fluctuations in the market, prices of oil, prices of, so there is a difference between price and value. And here's a really good analogy. If you were in the desert, right now I'm in London, it's January, there's running water and everything. If I was to come and give you a glass of water and charge you £1 for that, would you take it? I wouldn't. But if you were in the middle of the Sahara Desert and you were really thirsty, would you then take that? Would you then pay £1 for that glass of water? And there was no water at all for miles, and I had that glass of water. Do you think I could sell that glass of water to you for £1? The answer is definitely. I would pay for it because I value the water and I'm willing to pay the price. Because again, it's the situation has changed, and my psychology behind why the water, how I can get that water has changed. So why am I purchasing that water has changed? The environment's changed. The way I feel has changed. What the situation I'm in has changed. So of course I'm gonna pay. The same. It's still the same glass of water. It's still say it's 100 milliliters of water. Or it's a liter bottle of water. Say for example, it's still that same liter, but my psychology has changed, which is why I'm willing to pay that £1 for it. I'd probably be willing to pay £100 for it. Whereas right now I wouldn't pay anything for it. I'd just go to the kitchen and just fill up the water in my water bottle. So price and value is two different things, and that's something that we all have to really recognize and not get too fooled by the two. So that's how, and that's the basis of Warren Buffett's investing. He's a value investor, like I said. Anyway, go back to the book. So Bevelin says, this return can then be compared with the expected return from other available opportunities. Since my return depends on the price I pay compared with what it's worth, I should never pay more than what I get back in value. So Buffett says, what is investing if it's not the act of seeking value at least sufficient to justify the amount paid? Bevelin's point says, to do that, I need to be able to figure out what a financial asset is worth. How else can I know what kind of return I can expect at a given price? And in Buffett's words, he says, we will look at any category of investment so long as we understand the business we are buying into and believe that the price and the value may differ significantly. So he's looking at purchasing businesses that he understands where the price and the value, there's a big difference, and he's getting it at a lower price than the value it's worth, you know. I think he calls that the margin for error. So, all right, say we use a real life example. Say Deadpool. Deadpool last year, 2016, was released in February 2016 on Valentine's Day. It was a movie that was made for $40 million, I believe it was $40 million. Now, the company, the 20th Century Fox, or 21st Century Fox, they let Ryan Reynolds and the team make the movie after it had a viral success online with a short film that they did, and the marketing campaign for that was really phenomenal. Now, they only gave them a budget of $40 million. So in their mind, if I'm the studio, I'm thinking, okay, I'm going to give you $40 million budget. I'm hoping that this grosses like $100 million at the box office. I don't want it to gross $41 million. That's too tight. If I expect, it's going to gross at about $41 million, I'm not going to give you $40 million to make the movie. I'll give you $5 million, you know, because you need that margin of safety. What ended up happening is that it grossed over $700 million at the box office. They weren't expecting that. Nobody was expecting that. Deadpool wasn't even though it's a Marvel character, it wasn't a well-known character at the time. It wasn't a well-known property at the time, but it ended up grossing over 700 million. The market, and it was mainly because of the marketing campaign, which was phenomenal. And I definitely recommend you check that out if you haven't. You're one of the rare people on the planet who hasn't checked out all the marketing for Deadpool. It was really brilliant marketing. Now, that is a good return on investment. That's a massive margin of safety, but they were expecting it to bring in like 150 million in its lifetime, you know. So that's why they gave them 40 million, you know, because they have to obviously pay the actors, they have to pay the producers, the filmmaking team, they have to pay for props, they have to pay for effects, they have to pay for post-production, you know, marketing. They have to have all those things in account. They need to get their money back, and also they have to make profit on that because it's a business at the end of the day. But look at the results. So if your margin of safety, if you're going to buy something, if you're expecting something to bring you £30, just put it down in perspective. If you expect something to bring you £30 of value, then don't purchase the asset at £29. That doesn't make sense, because you're giving yourself a £1 margin of error, because there will always be error. So you want a margin of safety that's a lot larger. So if you're expecting £30 of value, then maybe you'll be looking to purchase that asset at maybe £5, because even if it comes in at £20, you've still got that margin of error, and you've got £15 as a safety. So that's how Buffett invests. Okay, so chapter 2 is valuation. Bevelin says, follow the cash. It's the only thing I can spend. So Buffett's words: in the theory of investment value, written over 50 years ago, John Burr Williams set forth the equation of value, which we condense here. The value of any stock, bond, or business today is determined by the cash inflows and outflows, discounted at an appropriate interest rate that can be expected to occur during the remaining life of an asset. So in other words, it's all about cash, liquidity. It's not about profit necessarily, because if you look at a financial statement and you look at net profit, that doesn't tell you the entire story of what the company did for that period of time. You have to see the full picture. You need to see the statement of cash flows, and there's 3 different types of cash flows. I'm not going to get into all that because, again, 1, I'm a student, I'm learning all that stuff right now, and 2, we want to just focus on what Buffett is talking about regarding investing. So I'd recommend take an accounting course, learn these accounting terms. If you don't understand some of these terms that are being thrown around, it's important to know the language of money, because if you go to China, you want to speak Chinese or have an interpreter. I'm telling you, I've been to China, or you won't get anywhere. So it's the same with money. If you don't speak the language of money, how can you expect to have it? You might make it and then lose it, and then make it and then lose it, like most of us do, but you can't be wealthy. You can't have stability in your financial life if you don't understand these terms. You must speak the language of money, especially if you want to be an entrepreneur and start your own business. You must know the language of money, and that's why most businesses fail. It's not because business is hard, or it's just as difficult as doing anything, but you need to understand it. He does actually make a point about that in this book about accounting terms and being the language of money. And I've heard many entrepreneurs and investors say this, the successful ones anyway. They all say the same thing. So because with the numbers, they don't lie. People lie, but numbers don't lie. And if you understand the financials, you can tell the story of a company just by looking at the financial statement. You don't even need to go into the company building and talk to the people, and you can just see it. You can say, oh, they've spent this much on inventory, or they're expanding, or you can see the numbers. The numbers don't lie, because economics is spoken by numbers. That, like, the vote of the market votes by the money that they spend, how they distribute their cash, or how they spend their cash. So let's like with the Deadpool example, for example, the market spoke. It said we like Deadpool. We want to see more of it. Well, they're going to do a sequel, and they are working on the sequel. If it made 35 million, they wouldn't be doing a sequel because it says that the market doesn't want to see Deadpool. Numbers don't lie. So. Next point. So Bevelin says, since the future is unknown, value is naturally a rough estimate, not a precise figure. Buffett says, the calculation of intrinsic value, though, is not so simple. As our definition suggests, intrinsic value is an estimate rather than a precise figure, and it is additionally an estimate that must be changed if interest rates move or forecasts of future cash flows are revised. He also says, despite its fuzziness, however, intrinsic value is all important and is the only logical way to evaluate the relative attractiveness of investments and businesses. So again, it's about intrinsic value. What is the business doing? It's not about, I like Apple because they make iPhones, let me buy a stock in Apple. It's like, no, what is the price I'm paying versus what is the value I'm getting? I think there's a term called PE ratio, which kind of determines this kind of thing when you're looking at stocks. Again, I'm not going to get into that. I'm a student. Look it up, and you'll understand what it is. Okay, so chapter 3, it's the value of a business. Now, Bevelin says, he talks about something called book value. I'll define book value. This is one of the financial terms I will define. Book value is, now what book value is in accounting terms is this: the net dollar value at which an asset is carried on a firm's balance sheet. For example, a building purchased at 900,000 but depreciated at 200,000 has a book value of 700,000. An accounting concept bears little relation to the asset's market value. So that's the definition of book value. Again, if you don't understand those terms, things like depreciation, there's a term called amortization. These are accounting terms that you must know. You must know them. Depreciation, it's when you purchase a tangible asset. So for example, if I'm in the film industry and I have a Canon C100 camera, I purchased that at I don't know, $4,000. So that camera, it now obviously, since as soon as I buy it, it goes down in it's going down in value every year. So as it goes down in value, this is called a depreciation. Now with amortization, it's intangible assets. Say for example, the brand logo and artistic things. So though that's the same kind of evaluation, but for intangibles. So that's the terminology for that. But again, I'm not an accountant. You should definitely get an accountant and learn, or take an accounting course and learn these terms, because you need to know them. You need to know them. These are the things we should have been taught in school. Because the one common denominator, you could be a hairdresser, you could be a filmmaker like myself, you can be a graphic designer, you can be an artist, you can be a HR manager, you can be whatever. Beautician. We all use money. We live in the modern world. Unless you're an indigenous person who lives in the rainforests and gets your own food and builds your own home, it's a goods exchange. We live in an exchange society. You need to pay someone else so that they can feed their family for the work that they've done for you. So learn these terms. So in regards to book value, Peter Bevelin says book value is almost unrelated to value, which is kind of what that definition was saying. It's per share intrinsic value, not book value, that counts. This is Buffett talking, by the way. Book value is an accounting term that measures the capital, including retained earnings, that have been put into the business. Intrinsic value is a present value estimate of the cash that can be taken out of a business during its remaining life. For example, just before they went bankrupt, LTV and Baldwin United purchased year-end audits showing their book values to be $652 million and $397 million, respectively. Conversely, Bilgewater Oil was sold to Shell in 1979 for $3.6 billion, although its book value was only $177 million. You see, so you see in there the difference between book value and intrinsic value. It's the intrinsic value that you want to look at as an investor. Or in terms of an investor is it's more of a mindset. It's not just about purchasing businesses. It's one thing that I've learned is it's when you're purchasing stuff. A lot of us are trained to be consumers and not investors. So when you're putting your money into something, you are investing in a way. You're investing your money and also your time, depending on what you're doing. Right now you're investing time listening to this video or watching this video. Hopefully it's bringing you more value for the time that you're spending here. That's what I hope. So you have to think of things that you do as an investor if you want to get ahead, especially financially. But we're talking in terms of financially right now, not necessarily in terms of things like relationships and enjoying your life and all that stuff. That obviously you want to invest your time wisely in those areas, but we're purely talking financial right now because we're talking about Warren Buffett's investing methods. So anyway, back to the book. Right. You can gain some insight into the differences between book value and intrinsic value by looking at one form of investment, a college education. Think of education's cost as its book value. If its cost is to be accurate, it should include the earnings that were foregone by the student because he chose college rather than a job. Some graduates will find that the book value of the education exceeds the intrinsic value, which means that whoever paid for the education didn't get his money's worth. In other cases, the intrinsic value of an education will far exceed its book value, a result that proves capital was wisely deployed. In all cases, what is clear is that book value is meaningless as an indicator of intrinsic value. So again, this goes back to that. This subject is something I feel very strongly about. You know, we all told we have to go to school and get degrees and all of this business, but a lot of people who do all that, they can't even find a job. They have no real world skills. They don't understand all these things we're talking about now. So you have to think, you now 15, 20 grand, 25 grand, however much you paid for university in debt. Have you had the return on your investment? Have you netted 25 grand? You know, in a period of time as well, because you don't want it to be 50, 60 years until you get a return on your investment. That's another thing. It's ROI, return on investment. It's just how quickly can I get my money back. That's what investors always look at. So that's another point to think about if you want to go to university and get a degree. Some careers, it's worth it. Obviously if you want to be a doctor, you need to go through the procedure, and they train doctors very well, so it brings back a lot more value for people who want to do that. But for a lot of other things, you don't necessarily need to do that. You don't necessarily need to go to university because it's not bringing you a good return on your investment. So it's something to think about. I mean, there's no right or wrong, but I feel a certain way about it, but won't get into that. And Bevelin says, and so are a lot of other yardsticks. So, common yardsticks such as dividend yield, the ratio of price to earnings, or the PE ratio, as I was saying earlier, or to book value, and even growth rates have nothing to do with valuation, except to the extent they provide clues to the amount and timing of cash flows into and from the business. So it's all about cash flow. Indeed, growth can destroy value if it requires cash inputs in the early years and the project or enterprise that exceed the discounted value of the cash that those assets will generate in later years. Growth is simply a component, usually a plus, sometimes a minus, in the value equation. So, Bevelin says, watch out for optimistic accounting and accounting maneuvers. And in Buffett's words, the term earnings has a precise ring to it, and when an earnings figure is accompanied by an unqualified auditor's certificate, a naive reader might think it comparable to certitude to pi, calculated to dozens of decimal places. In reality, however, earnings can be as pliable as putty when a charlatan heads the company reporting them. Eventually, truth will surface, but in the meantime, a lot of money can change hands. Indeed, some important American fortunes have been created by monetization of accounting mirages. In the long run, of course, trouble awaits managers that paper over operating problems with accounting maneuvers. Eventually, managers of this kind achieve the same result as a seriously ill patient who tells the doctor, I can't afford the operation, but would you accept a small payment to touch up the x-rays? So in other words, don't lie about the accounting, show it for what it is so you can deal with the problem, I think that analogy basically simplified that. Okay, so we'll move on to the next chapter. So chapter 4, return on tangible invested capital reflects the cash flow generating characteristics of the business. Okay, so Warren Buffett says, any company's level of profitability is determined by 3 items. 1, what its assets earn. 2, what its liabilities cost. And 3, its utilization of leverage. That is, the degree to which its assets are funded by liabilities rather than equity. Okay. A business obtains the best financial results possible by managing both sides of its balance sheet well. This means obtaining the highest possible return on assets and the lowest possible cost of liabilities. Okay. So, Bevelin says the higher return a business earns on the capital that is invested in the business, the more cash it is producing and the more value is being created. Again, it's all about cash flow, or how much cash flow is being produced by the business. So, anyway, Warren Buffett says, our preference would be to reach our goal by directly owning a diversified group of businesses that generate cash and consistently earn above average return on capital. So he puts money in, he wants to see ROI, he wants to see return on investment, and he wants to see something that produces cash regularly, so that's the important part of purchasing a business. You have to look at the statement of cash flows. You need to see what it's doing, on a regular basis. Okay, chapter 5, business characteristics, the great, the good, and the gruesome. So Buffett says, our acquisition preferences run towards businesses that generate cash, not that consume it. So I think a lot of businesses have this problem where they're not self-sustaining, they're not generating cash, so they're looking for outside investment or certain things to happen in order for them to operate, and that's a dangerous place to be in. A lot of small businesses have this problem, so that's a point to think about. The man Warren Buffett is talking about. And those are, Bevelin asks, the best businesses by far for owners continue to be those that have high returns on capital and that require little increment investment to grow. So it's businesses that you don't need to invest a lot of money in order for them to grow, as he was saying. So Bevelin says, the really great business, high return and sustainable competitive advantage, and obstacles that make it tough for new companies to enter. So watching your competition. So Buffett's words, a truly great business must have an enduring moat that protects the excellent return on an invested capital. Okay, so with a moat, what that is if you see, like in the medieval times, there's a castle and it's got a moat around it. Maybe it's full of water and it's like a lake that goes around the castle, so it protects the enemies from coming in or being able to invade that piece of land. So that's a good metaphor for protection on your business. So moats can widen or shrink. Long-term competitive advantage in a stable industry is what we seek in a business. Leadership alone provides no certainties. Witness the shock some years back that General Motors, IBM and Stearns, all of which have enjoyed long periods of seemingly invincibility. So this is the same for Blockbuster Video, for example. They thought, they had been in the business for a long time, and they got cocky, basically. I mean, no offense to Blockbuster, but when you look at it, they had the market for the home video and home entertainment, but they didn't adapt to the changes in the market, the internet. They didn't adapt to streaming and online video. But Netflix came along, and they did. The owner of Netflix came along, and it's not something that none of us could have seen that trend. But obviously the owner of Netflix took action. Now, that put Blockbuster out of business because they didn't change, they weren't adaptable. So another company came and they took the market, and now Netflix is massive. I heard, according to, I think it was Mark Cuban, I don't know if it was Mark Cuban or someone, because I know Mark Cuban owns some shares in Netflix. But at one point, I think in the, I don't know if it's still the case, but over 10% or 40%, I can't remember the percentage, of the internet use in the United States alone was because of Netflix streaming. So it's such a massive market that Blockbuster missed out on because they weren't adaptable. They didn't create that protective moat that they had the market. They didn't adapt. So that's an example of that. So it says that Buffett says the dynamics of capitalism guarantee that competitors will repeatedly assault any business castle that is earning high returns. Therefore, a formidable barrier, such as a company's being the low-cost producer, Geico, Costco, or possessing a wonderful worldwide brand such as Coca-Cola, Gillette, American Express, is essential for sustained success. Business history is filled with Roman candles, companies whose moats proved illusory and was soon crossed. So, like I gave as an example, was with Blockbuster Video. I'm giving film and TV examples, obviously, because that's the industry I know. That's my circle of competence. So that's what I can talk about. Another example is Kodak. You know, they were over 100 years. I believe they were around for over 100 years, and they were put out of business. The same year they were put out of business, there's a company that came into play called Instagram. You know, and now they're a big player in the market now. You know, so again, they didn't adapt. They didn't have that moat. You know, they didn't adapt to the new times. So it doesn't matter if you're a 100-year-old company. The market doesn't care. The market wants what it wants. And if you don't adapt to that, and you get too cocky, then those things happen. Buffett, what does Buffett say? He says, if a business requires a superstar to produce great results, the business itself cannot be deemed great. This is a good point, because I see a lot of, and I meet a lot of young, not even young, just a lot of small business owners that, you know, they're doing great things. You know, they're starting a new company, and you know, they've got a great idea and a great product, great services, but they are the superstar of the show. They're not training their staff and their people. You know, they're not duplicatable. They need to be in the business for it to be successful, and they're reluctant to let it go because it's their baby. But I don't know. I find that the most successful companies I see are the ones that, you know, you're duplicatable. You know, so you're not just relying on that one superstar, as Buffett says. Bevelin says, a great business has pricing power, or the power to raise prices without losing business to a competitor. So Buffett's words are, an economic franchise arises from a product or service that, one, is needed or desired, two, is thought by its customers to have no close substitute, and three, is not subject to price regulation. The existence of all three conditions will be demonstrated by a company's ability to regularly price its product or service aggressively, and thereby to earn high rates of return on capital. Okay? So again, it comes back to return on that capital. Moreover, franchises can tolerate mismanagement. Inept managers may diminish a franchise's profitability, but they cannot inflict mortal damage. So again, that business structure needs to be stronger than one individual, you know, or individuals. Right. So Bevelin says the best protection against inflation is a great business. And what Buffett says, such favoured business must have two characteristics. One, an ability to increase prices rather than easily, even when product demand is flat and capacity is not fully utilised, without fear of significant loss of either market share or unit volume. And two, an ability to accommodate large dollar volume increases in business, often produced more by inflation than by real growth, with only minor additional investment on capital. Okay. And Buffett also says, an unleveraged business that requires some net tangible assets to operate, and almost all do, is hurt by inflation. Businesses needing little in the way of tangible assets simply are hurt the least. So I mean, we can go to the example again. Go back to that Blockbuster Netflix example. Blockbuster requires stores. It requires inventory in terms of DVDs and videos and all these kind of things. Whereas Netflix, so those are tangible assets. Netflix has intangibles because it's a website. It streams, so it has a database of all these films that can be streamed, to millions of people at one time and convenience of their home immediately. So that's the pros and cons of intangible assets versus tangible assets in one sense of the word, from what my understanding of what Buffett is saying there. Okay. So, Bevelin talks about the gruesome require a lot of capital at low return business. Now, Buffett says the worst sort of business is one that grows rapidly, requires significant capital to engender the growth, and then earns little or no money. Think airlines. So, for example, you don't want to require a lot of capital, but you're not bringing in a lot of capital. I think again that makes economic common sense. So Bevelin says on Berkshire's unfortunate experience with the textile industry. Buffett says the domestic textile industry operates in a commodity business, competing in the world market, in which substantial excess capacity exists. Much of the trouble we experienced was attributable, both directly and indirectly, to competition from foreign countries whose workers are paid a small fraction of the US minimum wage. So again, when people talk about, we're losing our jobs, they don't understand that there are places where in the world where they can do the same job for less money. So therefore, you are going to put other people out of business. Again, it's a competitive market. So it's like if you can buy, we'll go back to the iPhone example. You buy an iPhone for 700 or for 100. What are you going to do? You're going to buy the iPhone for 700. I mean, I'm using those kind of examples because most of us have been trained to be consumers. So we see, it's easier to see the value in something like a tangible item like an iPhone. Because maybe some of us don't understand the value of businesses and how they operate. I mean, the real value of businesses and how they operate. But that's what we're learning here. Okay, so on the correct way to look at accounting goodwill. So Buffett says, we believe managers and investors alike should view intangible assets from two perspectives. So Bevan says, when you evaluate the attractiveness of a business, look at the return on net tangible assets. So, in Buffett's words, 1. In analysis of operating results, that is, in evaluating and underlining economics of a business unit, amortization charges should be ignored. What the business can be expected to earn on unleveraged net tangible assets, including any charges against earnings for amortization of goodwill, is the best guide to the economic attractiveness of the operation. It is also the best guide to the current value of the operation's economic goodwill. So Bevelin says, goodwill should not be amortized, but written off when necessary. In evaluating the wisdom of the business acquisitions, amortization charges should be ignored also. They should be deducted neither from earnings nor from the cost of the business. This means forever viewing purchase goodwill at its full cost before any amortization. Furthermore, costs should be defined as including the full intrinsic business value, not just the recorded accounting value. Of all consideration given, irrespective of market prices of securities involved at the time of mergers and irrespective of whether pooling treatment was allowed. And Buffett says, the truly big investment idea can usually be explained in a short paragraph. So that's the importance of simplicity. So, part 6, past results as a guide. Something useful and something dangerous. So Bevelin says, what is normal cash flow? How representative is past information? Why was the past the way it was? What factors were responsible for generating past cash flows? Are they present today? What forces can change them? The past is useful if it gives me any clues to the future. So, in Buffett's words, he says, in the business world, the rearview mirror is always clearer than the windshield. It's the windshield through which the investors must peer, and the glass is invariably fogged. So we believe our formula, the purchase and sensible prices of the business that have good underlying economics and are run by honest and able people, is certain to produce reasonable success. So it's very simple. It's very simple. The people need to be honest that run the business. So they don't provide the managers, they don't provide the personnel, you know, they're providing the investment. And the formula basically is, again, purchasing businesses at a sensible price for the value that they're getting for the business and that the business is producing. Okay, so he goes on to talk about the housing crisis of 2008. So he goes on to talk about the housing crisis of 2008. Sometimes the past can be very misleading. The 2008 housing crisis. So Buffett's words regarding this were, just about all Americans came to believe that the house prices would forever rise. That conviction made the borrower's income and cash equity seem unimportant to lenders who shoveled out money, confident that HPA, house price appreciation, would cure all problems. So in other words, they bought the house at a certain price and they were just hoping it would go up in value. So it's a form of gambling in a way, you know. They weren't looking at the intrinsic value. What is it that I am paying for it? And you have to look at the rent. How much can I rent it out? Say for example, I purchase a property and it rents out for £1,000 a month. That's £1,200 a year. Say if I have a 30-year mortgage, I now need to calculate how much that's going to bring me in that 30 years, you know. And if that value is low, if the price is lower than the value, then I purchase. I don't purchase based on I bought the house at this amount and I'm hoping it to be this amount. I mean, it's unfortunate a lot of people were caught in that situation in 2008. People lost their homes. It's really unfortunate. But again, this is a sin of the system that we're not taught this financial education. So people are making decisions without having they're not making educated decisions. They're making decisions based on gut feelings and the fact that people are saying everything's going up and trends, you know, but markets go up and down, you know, and sideways. But an investor will make money no matter what the market's doing. People like Warren Buffett make money no matter what the market's doing because they understand intrinsic value. They understand value investing. And that's what we need to learn, you know, so that people don't go through these kind of crises. Again, they don't lose their homes, you know. I mean, I think that must be terrible to lose a home, you know, especially if you've got a family, you know, you've got kids, you've got a wife, and you just lose your home. And it's not, that must be a terrible experience. I've never lost a home, but I can only imagine. And it's because people were taken advantage of because of their lack of education on this. So I think it's really important. These are the reasons it's important to learn this stuff, you know. We'll move on to the next chapter. There was so much in there. I could again talk about this book for ages. I could literally recite everything he said, because everything that comes out of Warren Buffett's mouth is a lot of wisdom when it comes to finance. So I would highly suggest getting the book yourself and reading it, you know, reading the whole thing. So, chapter 7, the importance of a trustworthy and talented management. So, Bevelin says, stick to proven management with a lot of integrity, talent and passion. Buffett's words, after some other mistakes, I learned to go into business only with people whom I like, trust and admire. Now, I really want to hammer on this point. I hate people say it's not personal, it's just business. Of course it's personal. People are spending their time and energy in a company for many years and many hours of their day away from their family, away from their friends, to be in a company, and the company's producing revenue. A lot of this revenue is used to pay the salaries of the people in there, in that business. So it is personal. And if you're going to work with people, you need to trust them. You need to like them. You need to get along. You know, it is a personal thing at the end of the day. It's people's time, energy, skill set, you know, that's being put into a company. So it's really important to, I think you're hearing it from the best, you know, he's saying it. He wants to work with people that he likes, admires and trusts. And it's something I totally agree with. So I think it's a really dangerous attitude to have, and that it's not personal, it's just business, and just have this business head. That's not how the real world works, you know. I think a lot of people have that, unfortunately, have had bad experiences, so they believe that's the best way to conduct business. But I mean, again, Warren Buffett knows what he's talking about. So I mean, that's not this. If that works for you, I guess that's fine. But I think it's important to trust the people you work with, to like them, you know, because you're spending time with them, you know, at the end of the day. And if they're running your company, you know, you're entrusting them to produce basically for your baby, which is your company or your investment, you know. So Buffett says, we do not wish to join with managers who lack admirable qualities, no matter how attractive the prospect of their business. We've never succeeded in making a good deal with a bad person. And now Bevelin says, one doesn't need an MBA to be talented. So Berkshire's CEO come in many forms. Some have MBAs, others never finished college. Some use budgets and are by the book types. Others operate by the seat of their pants. Our team resembles a baseball squad, compiled of all-stars, having vastly different batting styles. Changes in our lineup are seldom required. Okay. So we'll go on to chapter 8, the importance of clear yardsticks to judge management performance. Bevelin says, don't automatically be impressed by higher earnings. And in Buffett's words, while an increase in earnings from $8 million to $72 million sounds terrific, and usually is, you should not automatically assume that to be the case. You must first make sure that the earnings are not severely depressed in the base year. If they were instead substantial in relation to capital employed, an even more important point must be examined. How much additional capital was required to produce the additional earnings? Okay, so chapter 9 on corporate governance. So Bevelin says the board's most important job is to pick the right person to run the business and evaluate their performance. Now, Buffett's words, this means that directors must get rid of a manager who is mediocre or worse, no matter how likable he is. The key criteria of choosing directors. Now, Buffett's words. In selecting a new director, we were guided by our long-standing criteria, which are that board members be owner-orientated, business-savvy, interested, and truly independent. So again, it's having that business savvy, that knowledge, knowing accounting terms, knowing how businesses run, how to deal with people, how to be influential. These qualities are the qualities of a good business owner. He's looking at that. He's looking at people passionate about the business, not just, you know, for the sake of having an MBA, you know, or degree. It's more these tangible qualities that he's looking for. Now he says the rarest of these qualities is business savvy. Many people who are smart, articulate, and admired have no real understanding of business. Then that's no sin. They may shine elsewhere, but they don't belong in the corporate boards. So it's important to be business savvy. A lot of people think they are, but they're not. You know, you need to compare yourself to people like Warren Buffett. don't compare yourself to someone who knows a little bit more than you. Do you read financial reports, annual reports? You know, how many companies have you started? You know, have you learned from mistakes? You know, all this kind of stuff. You know, how good are you at dealing with people, leading people? You know, do you know the right people to employ? You know, do you know how to hire and fire, HR? You know, do you know the difference between amortization and depreciation? This is business savvy. You know, these are the things that we need to educate ourselves on, especially if we want to be entrepreneurs, investors. You know, if you want to be an employee, then you don't need to necessarily know these things. You know, you can shine being good at what you do. You know, and there are many people who that's the right option for them. But as an investor or as an entrepreneur, you need to be business savvy. You know, that's just an education that is needed. You know, a financial education, a business education, an investor education. And the best education is to learn from the best. Learn from people like Buffett. Which I've been saying all this time because I just truly believe it. What he continues to say, Buffett continues to say, is Charlie, as in Charlie Munger, his business partner. Charlie and I believe that our 4 criteria are essential if directors are to do their job, which by law is to faithfully represent owners. Yet these criteria are usually ignored. Instead, consultants and CEOs seeking board candidates will often say, we're looking for a woman, or we're looking for an Hispanic, or looking for someone from abroad, or what have you. It sometimes sounds as if the mission is to stock Noah's Ark. Over the years, I've been queried many times about potential directors, and have yet to hear anyone ask, "Does he think like an intelligent owner?" So they don't care. The market, business, they don't care about your skin color, your sex, your race, where you're from. It's about, do you think like an owner? Are you an intelligent investor? Are you business savvy? That's it, you know, because results are all that matter. You know, no one cares about, you know, when you buy an iPhone, you don't care if the person was a woman who made it, or if it was an Hispanic, or if it was, you know, whoever, the person was black, white. Just care about, does the iPhone work? You know, it's the most important thing. You know, especially in this day and age of the information age, everything's done online. You know, you can have an app, you download an app, you don't know who the owners are. It could be a 14-year-old, and a lot of the times it is a 14-year-old kid who just started an app, and you know, he's a bit business savvy and he started something, and you're purchasing from him, you don't even know. You think you're buying from a reputable LTD limited company or LLC company, you know, but you're buying from some 14-year-old, you know, and his mate. It doesn't matter. You know. Okay, so 10, owners and management. At Berkshire, managers can be focused on running their businesses. They are not subjected to meetings and headquarters, nor financing worries, nor Wall Street harassment. Our trust is in people rather than process. A hire well, manage little code suits both them and me. So that's good. He's looking for leaders, you know. Which is good, because when you're hiring, it's important to, I guess, hire people who have a passion for the business or for what you're doing, and that are leaders. They can act on their own initiative. They can bring some value to the table, you know. So I'll move swiftly on. There's a lot of good points here, but I'm going to move swiftly on to chapter 11, management compensation. Now it talks about management compensation. So Bevelin says, work with people who make money with owners and not off them. So Buffett's words are, we have no interest in large salaries or options or other means of gaining an edge over you. We want to make money only when our partners do, and in exactly the same portion. Since I have a huge percentage of my net worth committed for life to Berkshire shares, and since the company will issue me neither restricted shares nor stock options, my gain-loss equation will always match that of other owners. So he says, so Bevelin says, and tied to the result of the area the manager is responsible for and can impact. Buffett says, when we use incentives, they are always tied to the operating results for which a given CEO has authority. We issue no lottery tickets that can pay off unrelated to the business performance. Okay, so Bevelin says the rewards can be large. In setting compensation, we like to hold out the promise of large carrots, but make sure their delivery is tied directly to results in the area that the manager controls. We do not put a cap on bonuses. Sorry, this is all Buffett's words, by the way. We do not put a cap on bonuses, and the potential for reward is not hierarchical. I like that. So it's not based on your title, your position. The manager of the relatively small unit can earn far more than the manager of a larger unit if results indicate he should. We believe further that such factors as seniority and age should not affect incentive compensation, though they sometimes influence basic compensation. A 20-year-old who can hit 300 is as valuable as a 40-year-old performing as well. So it's not about age, it's about performance. So he says the Geico plan exemplifies Berkshire's incentive compensation principles. Goals should be 1, tailored to the economics of the specific operating business. 2, simple in character, so that the degree to which they are being realized can be easily measured. And 3, directly related to the daily activities of the plan participants. Okay, so we'll move on to chapter 12. This is mergers and acquisitions. Dumb acquisitions cost owners far more than most other things. Okay. So Bevelin says the type of business Berkshire looks for is Warren's comments. Charlie and I look for companies that have A, a business we understand, B, favorable long-term economics, and C, able and trustworthy management, and D, a sensible price tag. The art of investing in public companies successfully is little different from the art of successfully acquiring subsidiaries. In each case, you simply want to acquire a sensible price, a business with excellent economics, and able, honest management. Thereafter, you need only monitor when these qualities are being preserved. So Berkshire's acquiring acquisition criteria. So Buffett says, we are eager to hear from principals or their representatives about businesses that meet all of the following criteria. 1, large purchases, at least $75 million of pre-tax earnings unless the business will fit into one of our existing units. 2, demonstrated consistent earning power. Future projections are of no interest to us, nor are turnaround situations. 3, business earnings, good return on equity while employing little or no debt. 4, management in place, we can't supply it. 5, simple businesses. If there's lots of technology, we won't understand it. And 6, an offering price. We don't want to waste our time or that of the seller by talking, even primarily, about the transaction when the price is unknown. Okay, so chapter 13. A few management issues. Be honest and trustworthy and select people you can trust. Bevelin's point. Don't hire and work with people you have to be told to be honest, nice and trustworthy. Hire and work with talented, honest, nice and trustworthy people. Buffett's words regarding this. Charlie and I know that the right players will make almost any team manager look good. We subscribe to the philosophy of Ogilvy and Mather's founding genius, David Ogilvy. If each of us hire people who are smaller than we are, we shall become a company of dwarfs. But if each of us hires people who are bigger than we are, we shall become a company of giants. Now, don't know David Ogilvy. He's one of the most legendary advertising men of the last few decades. I think he died. He's the author of this book, Confessions of an Advertising Man, another book that I'll review at a later time. That's the man there, gentleman there. He's known as one of the best advertisers of all time. So that's where he's getting that philosophy from. So he talks about communication. Now he says with owners, this is Buffett's words, he says, when Charlie and I read reports, we have no interest in the pictures of personnel, plants and products. We are very suspicious of accounting methodology that is vague or unclear, since too often that means management wishes to hide something, and we don't want to read messages that public relations departments or consultant has turned out. Instead, we expect the company's CEO to explain in his or her words what's happening. What needs to be reported is data that helps financially literate readers answer 3 key questions. 1. Approximately, how much is this company worth? 2. What is the likelihood that it can meet its future obligations? And 3. How good a job are the managers doing, given the hand that they have been dealt? So that's the most important thing you look at. Again, it's the raw data. It's the numbers. It's the financials. So we'll move on to chapter 14, how to reduce risk. Prevention is better than cure. Buffett's words. We define risk as using dictionary terms as the possibility of loss or injury. Charlie and I detest taking even small risks unless we feel we are being inadequately compensated for doing so. So it's a myth that that investing is risky. You know, what's risky is when you don't understand something and you do it without, you're hoping for a lottery win. But in the man's words himself, they don't want to take risks, unless there has to be an upside to what they're doing, And like they say, they like to stay in their circle of competency, Study hard so I know what to avoid, Bevelin says. So Buffett's words are, our vice chairman, Charlie Munger, has always emphasized the study of mistakes rather than successes, both in business and other aspects of life. He does so in the spirit of the man who said, all I want to know is where I'm going to die, so I'll never go there. So in other words, you want to know the dangers are so that you don't go there. So I don't focus too much on the successes, focus on the mistakes, and what you can learn from them and how to avoid them. Okay. There's a lot of great points here that are highlighted in this chapter. It's quite a long chapter. A lot of good information. But again, you need to read the book yourself. That's what I was saying. He also talks about how they have a no layoff policy, which I thought was really interesting. So they don't believe in layoffs. And it goes into a bit of detail in there. I'm going to read something about price, actually, and emotions. What he talks about is the right mental attitude towards the market fluctuations, like I was saying about prices going up and down. Now, so Bevelin says, evaluate the facts that count and be disciplined. Buffett's words, an investor will succeed by coupling good business judgment with an ability to institute his thoughts and behavior from the super contagious emotions that swirl about the marketplace. In my own efforts to stay insulated, I have found it's highly useful to keep Ben's Mr. Market concept firmly in mind. Imagine market quotations as coming from a remarkably accommodative fellow named Mr. Market, who is your partner in private business. Without fail, Mr. Market appears daily and names a price at which he will either buy your interest or sell you his. So, Bevelin, Mr. Market has some emotional problems, and Buffett says, at times he feels euphoric and can see only favourable factors affecting the business. When in that mood, he names a very high So he names a very high buy-sell price. At other times, he's depressed and can see nothing but trouble ahead for both business and world. On these occasions, he will name a very low price. So, what he's saying, from my interpretation of this, is it's all about the market. A lot of it is based on psychology. You know, the pricing of things is based on psychology. That's why you see when certain things like Brexit happen, then all of a sudden the price or the value of the pound goes down and this goes up, and you know the prices they fluctuate based on psychology. But an intelligent investor is someone who looks at intrinsic value at every turn. You know, he's not be letting his emotions run the show. He's letting his logic run the show. And when you listen to Buffett, he makes a lot of sense. A lot of the things he's saying goes along that kind of philosophy. Now he talks about Benjamin Graham. He says, as Ben Graham said, in the short term, the market is a voting machine, reflecting a voter registration test that requires only money, not intelligence or emotional stability. But in the long term, the market is a weighing machine. So the numbers again don't lie. You know what the market again with price the way that it fluctuates is one thing, but you know when you look at the intrinsic value of a business, what it's producing, these factors are truths. You know, if you have a business and it's selling 20 units of apples, or 20 boxes of apples a day, you know, at $20 each, you know, that's telling you something. It's telling you that there's a market for it. People need apples, you know, as opposed to maybe bananas that are only selling like 2 boxes a day. So there's the truth in those economics, you know. So chapter 15, sometimes mistakes are made. So Buffett says the trick is to learn most lessons from the experiences of other managers who have learned much from personal experience in the past. Usually are destined to learn much from the personal experience in the future. And he also says, Bevelin says, do postmortems on my dumb decisions. And then Buffett's words are, agonizing over errors is a mistake, but acknowledging and analyzing them can be useful, though that practice is rare in corporate boardrooms. There, Charlie and I almost never witness a candidate post-mortem of a failed decision, particularly in one involving an acquisition. A notable exception to this never look back approach is that of the Washington Post Company, which unfailingly and objectively reviews its acquisitions 3 years after they're made. Elsewhere, triumphs and trumpeted, but dumb decisions either get no follow-up or are rationalized. So basically, own up to your mistakes, learn from them. You know, we all make them. So a final word: think like a businessman. Buffett's words are, in what I think is by far the best book on investing ever written, The Intelligent Investor by Ben Graham. The last section of the last chapter begins with, investment is most intelligent when it is most businesslike. This section is called A Final Word, and it is appropriately titled. So again, like his mentor said, you're intelligent as an intelligent investor. You have to think like a businessman. You're an investor, but you're a businessman. You're an entrepreneur. You need to look at the business. When you purchase a stock, you're buying a share in a company. So it's just the same as you purchasing the entire company. you know. So you need to look at the numbers. You're not looking at the price and whether you can buy low, sell high. Value investors are looking to buy and hold forever so that this produces for them, you know. So you have to believe in what you're purchasing. You don't just buy it because it's the next trend, you know. And that's what he learned from his mentor, and that's what now I'm learning from him. The book ends with this really good quote by Confucius. It says, "In all things, success depends on previous preparation, and without such previous preparation, there is sure to be failure." Which is a great quote by Confucius. And on that note, prepare by reading this book. Read about Warren Buffett. There's several good books on Warren Buffett. There's a Snowball. There's a few other really good books. I recommend pick them up, learn from the man. Watch his YouTube videos. I've put a couple of them in the description below. Check them out and watch them. If you want to learn about business, money, finance, you need to know Warren Buffett. You know, third richest man in the world, one of the world's greatest investors. Give this book 5 out of 5. Definitely purchase this book. Find it. Its price versus its value, it's tenfold. Definitely. I'm gonna benefit a lot from the stuff that I've learned here, and I'll continue to use it as a reference for myself. You know, I'm picking up these things, these papers, you know, the Financial Times. I'm not really looking at the whole Donald Trump thing, more for the raw data below, the markets, because this determines a lot of things, you know, the price of oil, the S&P 500, all this thing, you know, Brent oil versus crude oil, you know, how that affects, you know, petrol prices and the soil that grows our food. This is which affects food prices. This is the language of money. This is all the stuff we were supposed to learn in school, you know. That's more important than who's the president and all this stuff. We have no control over that, but we have control over our education and what we can do for our family and friends. So and for ourselves. So I suggest purchase this book, Few Lessons from Investors and Managers from Warren Buffett by Peter Bevelin. Great read, and learn from the wisdom of the man. If you like the video, again, like, share, subscribe. Check out the other videos and my other book reviews. I review a book every week. I'm reading a book every week on different subjects to do with health, to do with wealth, to do with social life, love, family, friends, family, romance, and to do with happiness and fulfillment. All the pillars of the good life, you know. So check them out, and leave a comment below. Let me know what you thought of Warren Buffett's thoughts and any other thoughts you've got. And I'll see you next week for a book of the week.